Okay. We get started now. Number is increasing. Okay, folks. So we may get started with our program for today. Our program was interfered because of having so many public holiday, and with this public holiday, we lost about 3 days. So losing 3 days in 2 weeks' time, it means we have very little to be covered, and therefore we requested to have some kind of extension. So we will have today's class and also the class that will be taking place in the next week on Saturday to try to cover this one, because otherwise we wanted the extension to Monday, Tuesday, and Wednesday. We are supposed to cover for almost 3 days. With this, we are supposed to cover for 3 days, but I'll try to cover within 2 days. It means we have today and the next Saturday, and we will see the coverage. So some lecture you will find through video. So I will support you with some video material, of which you will find it is again useful for the same coverage. And for those individuals who could not be able to attend in a class, they will also find it easier to attend through online and also get some recorded lecture. So that is what happened. And if we have to change the plan, then you will let me know. So there will be some video coverage of which you will take your time to listen by yourself. And also, if you are not able to attend in the class physically, because we are living in the digital era, the era that is very sensitive. It is the era that we use wireless in everything that we do. So we will have some coverage for these 3 days coverage. 3 days coverage. It is a 3 days coverage. We'll have some coverage. We will talk much about capital budgeting, and we will talk capital budgeting. That is the aspect that we are going to talk. Looking at capital budgeting, we'll look at decision making when it comes to investments. We want to invest as a manager. As a manager, we want to invest. So we need to look at capital budgeting. And we also need to examine some aspects of decision making when it comes to big investments in your portfolio. So that is what we shall be looking at. And also, what is happening is we will be able to cover some costs. Some basic cost, just as a manager, you need to know some basic costing. What are those costing when it comes to the general cost with regards to your operation in your organizations? What are the fixed costs? What are the variable costs? What are the total costs? What are marginal revenue? What are the marginal cost? All these kind of things. And also we will be looking at some break-even points, decision criteria for ourselves to operate. That we shall be looking in terms of cost. We will also examine the budget. How do we draft a budget? These are key aspects that we need to cover. And because we are running shortage of time, so I said some other things will be covered through video participation, and also some other things we shall be getting through a lecture, just like the way we are talking in a live lecture. We will also talk about risk analysis. We will be examining the risk analysis what is the risk analysis and risk management? You know, why do we need to focus on those risks? What are the strategy to mitigate risks? Look at the risk register. As a manager, these are things that you shall be having. You shall be having in your organization, and you cannot go without risk. So risk is there. Some risk can be avoided. You set a strategy. Some risk we can control. That others we have to cope up with. So these are things that we shall be talking, and we will cover this. We will cover this, as I said, two approach that we'll be using to cover our class. One is online, and another one I will give you video, and another one you can read by yourself. You can review the lecture. You can retrieve the lecture that you'll find very useful. And again, I wish to invite you. You should be visiting the Moodle. You should be visiting the Moodle for material and for reading for yourself. For all readings, the lecture and everything will be found through videos in the Moodle. You find them in the Moodle. So everything that we do right now, you will find it right there. Is that okay? Folks, is that okay? Are we together, folks?
Yes, Doctor.
Okay, Doctor.
Yeah.
Good.
Yes, sir.
Yes, because sometimes I might be talking by myself. I thought maybe I'm talking with people, but people, they're there. Now, this is the plan that we have. I said we need 3 days that we lost. We lost the 3 days because of having public holiday, and we could not avoid us ourselves from not participating in public holiday. So we were compelled with the situation. You participated, but we lost the 3 days. And again, we will see on how we can cover these 3 days with maximum utility, maximum satisfaction level, at which alternatively video will cover the excess demand in terms of the coverage for this time. So for today, what we are going to do is we are going to talk about capital budgeting. We are going to talk about capital budgeting. This is what we are going to talk about. Let me check this one right here. We got something here. Let me see this one. Okay. This is okay. Great. Okay, let me share one document right here with you for this coverage for today. Let me share the document. It will be good for us to get the lecture in here. This lecture, as I said, can you see the blackboard? Can everybody see the blackboard?
Yes, Doctor.
Yes, sir. Yes, Doctor.
Great. Lovely. So, with this, we open again this window right here. Let me open the window in here. Good. We are talking about investment and capital budgeting. When we talk about investment and capital budgeting, this is the lifeblood of your organization. Your organization is characterized with profit maximization. You are characterized with the welfare maximization of the shareholders, of the beneficiaries, of the stakeholders. So you should be knowing, for you to look at which investment can bring more returns, which investment can cause loss for the future, which investment that we should be focusing and use all those kind of energy by ourselves and do investments. These are things as a manager you need to look at. We do not just go to investments where we find you can do any type of investment. At the end of the day, you are causing a loss. As a manager, we need to cope up with the environment of profit maximization. Now, you cannot go for profit maximization if you are not capable of making decision, making a scientific decision, knowing at which area we should maximize, which area we should maximize profit. You see, I don't know, there's some people writing, they're interfering right here, they're writing, start meeting summary. What's that? Do you have any question? Someone has written this. Do you have any question? If you have any question, please.
Oh, doctor, maybe he right there before you started sharing those slides. That's why he wanted maybe to show those slides. That's why he said, may you share writings. But currently you are sharing it. I think he's comfortable.
Yes. Yeah, okay. Okay. It's fine. It's fine. Yes, it's fine. I repeat, what we are going to cover, we are going to cover issue of capital budgeting, but again, the issue of cost and also the issue of risk analysis and management. Now, these three we were supposed to cover for the last week period, but our period has been interfered with the public holiday where we lost 3 days. So if we lost 3 days to cover this, we say at this time we will try to use 3 days, but we will cover 3 days, also apply technology to cover the same. There will be both online available material for the lecture. Our lecture is recorded, so you will get the lecture, and also and someone is also drawing up on the board. So guys, I know you know everything. So someone is drawing up the board. I can see right here. So humble yourself, okay? Humble yourself before you show your technology. This is a risky. This is part of the risky. I'm not the one drawing up there, but someone is drawing for us. So you will get material online. You will also get recorded video. You will get it. And also make sure, I told you, make sure you visit the Moodle. Make sure you visit the Moodle. These are things. So if you have another question, do we have another person with a question?
Question.
Good.
No,
Now, I was talking about capital budgeting. I don't know what happened, and we had to stop somewhere. They start talking. Someone interfered our class. Now it's like this, and I said, I'm recording everything, so you don't need to record. If I'm recording, you don't need to record. If I'm recording, you don't have that permission, and I don't give you permission. I'm recording, so please, I'm recording all conversations. You will get all these video. You will also get the recorded one at your own time. So what we are talking about right here is the capital budgeting, investment and capital budgeting. We need investments. We need, as a manager, we need to invest. As a manager, you should be exploring on which area your organization should invest. What are the areas that can maximize shareholders' wealth? Which area can be more profitable for us? You know, which area we are going to use? We are going to use a fund from commercial banks. to do investment, because we cannot do by using our own money, but we will use money from commercial bank where we need to go and invest in investable areas that they will give us returns. So you see, this is the question. This is the question for any manager. For any serious manager, must consider the capital budgeting principles before deciding anything. Apart from saying you will have your own analysis, but you go to the bank, you borrow billions of money. You go to the bank before you go and borrow the money. Before you go and borrow, there must be a scientific decision for you to say, we go or we don't go with this investment. Investments, a serious manager is always thinking about his own organization, welfare, the welfare of the organization. That's the serious manager mindset. You're always like that. How are we going to invest? In which area are going to be very much profitable? And if we run into that, is that going to be a profitable investment? Is that going to improve our organization? These are things that any manager will have to consider. So this is the scientific decision. This is the scientific decision, and this is very critical aspects for running the organization. And for running your business, you will need on how to maximize profit. You will need on how to manage the risk. You will need to tell us about the growth of your organization. A serious manager will plan the organization 5 years ahead. That is what he will be looking at. That is a serious manager. But some managers, they are looking at current year's revenue. That is not serious manager. You should not, as a manager, you should not be sleeping. You'll be focusing at profitability and welfare of your staff. You should be looking at future growth of the organization. You should be looking at different risks that are associated with the organization. And that is the mindset. And that's why when you go to countries like China, when you go to countries like UK, when you go to USA, their performance level is different from the African performance level because of investment decision. And when they go and invest somewhere, risk is calculated. The environment has been scanned. They go, they come and invest. That's why they develop. That's why they develop. So these are concepts to which you cannot deny. When we talk about capital budgeting, we talk about how are we going to make decisions about our investments. We want to construct dams. We want to open up a shop. Oh yes, you can open up a shop, just very simple. When you look at, some of you are applying different techniques. You can apply, if you're opening up a simple shop, a business, and you're running, or maybe you want to expand, you can apply payback period. You can use any type of criteria. You can use internal rate of return if you're borrowing. You can use the net present value and the others. Now, which investments criteria as a manager you will use to do that? And this is what we needed to cover with this, so that at the end of the day, we may be able to maximize the firm's worth. As a manager, you need to know money is valuable resource. As a manager, you need to know different alternatives of investments. As a manager, you need to know what are the reactions for present time against the future as compared with the time value of money. As a manager, you need to know your money is being affected by using, your money is affected with inflation. So inflation affects your money. You should know as a manager, you should know that the value of your investment, the value of your money that's kept in your bank account is worn out as a result of inflation and other issues. As a manager, you should know. So you need to check different alternatives towards investments as a manager. As a manager, you need to know. And this is what we call it a capital budget. This is what we call it capital budget techniques that we apply to do this. Investment is needed in all our contexts. We need investments. You need investments. I need investments. We need companies that do investments. We need organizations that do investments. We don't, like today we are talking about, there is less investment taking place. And that's why you find unemployment is very high. Why do you think unemployment is very high? It's because there is the process of creating those investments is limited by the managers of today. I don't know whether you understand what I'm talking about. You know what
understand.
I'm talking? Yes. We are limited. Why? We are limited. You're limited because why? Look right here. We say if people can save, if you can do saving, this will promote you to do investment. Now, that's the basic formula. That's the basic formula. And that's always being performed. That if you have saving, then you can have investment. Now, if you have investments, what it means, there will be growth. There will be growth of an organization. There will be growth of an organization. Because why? Your organization will also get income, and the people will, the organization will get income. The organization, let me lab this one. Let me lab, get this one right here. Yeah. Okay. Get back to the point. We need to make, for every organization, if we can get serious manager, and that's what we need. Tanzania needs serious manager. Africa needs serious manager who are ready to examine the future in the next 5 years, what will be happening. They need to do some kind of savings, but again, when you do saving, it will lead into investments, and these investments, you will enhance growth of your organization. We need that. We need that. And this will create income to the people. So we get income. We will get income. People will get income, and the organization will get revenue the same time. We'll get revenue at the same time. And this revenue will bring about multiplier effects to people. We need these type of managers. We need these type of managers. We need these type of managers with those kind of thinking, with those kind of thinking. And that's why when you go to China, you'll find how Chinese managers are positioned, how Chinese managers perform their work. Compare and contrast with the African manager, specifically with the Tanzanian manager, how their mindset is. Chinese managers are serious. That's why there is a lot of innovation that's going on. Everybody wants to go to China and get some commodities. Everybody, and most of us, we use Chinese technology. Even the laptop that you are using is made in China. The pants, the shirts, your shoes, your belt, your everything is made in China because of the thinking. Because of the thinking. Our managers are not to that level. So that's why we are in this class. We need to know we should take our organization to that level. We should take our organization to that level where we can compete worldwide. We can compete with the Chinese. We can compete with American. We can compete with the UK-based companies. We can compete with the Kenyan's company and so on. These are the managers that we want. These are the managers that we want in the global context. We want these type of managers. So if we are missing this, what we will see is most of the time we need to use, we have to use the so-called capital budgeting to make a decision. You will go to the bank, you will approach the bank, you will borrow money. There will be interest rate. There will be installments you will need to pay. What are the implications? You see, what are the implications? The bank managers, the directors, what are they looking for? These are capital budgeting issues. Good. I hope we are together. So, what are the factors? What are the factors that we look when it comes to investment evaluation? Go to investments that it has financial viability. That is factor number one. A serious manager will go and invest in the area where it is investable, and he will be looking at those investments and advise members of management, advising directors, advising the rest of the people that there is a returns. There is a returns in this type of investment that we are making. There is a returns that we are going to make. The investment is viable. Don't go to any investment that is not viable. Don't go and invest into those investments where there is no returns. Don't go and invest in an area that will absorb funds. Don't go. Don't go. So what do we use? So we use different types of criteria to promote this. One of them, we use NPV. You can use payback period. You can use internal rate of return. You can use accounting rate of return. You can use the profitability index. You can use the benefit cost ratio to make decisions after assessing your cash flow. After assessing your cash flow. These are things a serious manager will be working on. These are things. Manager, apart from looking at the viability, will also check for the market. You cannot just go and buy some products for fun unless you go for non-profit making. But it is resource, folks. It is a resource. So you must look at the market. It isn't like the position of the government will make justification based on the needs. But for the organization, as far as concerned, we'll look at the market analysis, we'll look at demand projection. Is there demand for the products? Is there capability for people to buy the products? Is there growth? You see, can we invest in here to absorb the demand? Can we compete in how we should compete? These are things that manager will be looking at. What we say this: any business must assess the market trend. Any business must assess customer preferences. These are things, as a manager, you will be looking at. These are the areas that, as a manager, you check the landscape of your customer preference. You check the trend of your customers. That is what we want. That is what we want. Don't go for production of goods and services that it is less demand. You will create loss. You will not sustain. The organization will collapse. Always check customers' preference. Assess the risk properly. You must assess all risk properly. There are two types of people in there. There are two types of people in there. Of course, you should say, you cannot avoid all risks in investments. You cannot run away from a risk. Other risk we are born to cope with. We are born to cope with. So a good manager understands, but we have two types of managers in there. The first one is the risk-averse manager. The manager who's running away from taking risk. And we have another one who is risk-taker manager. So you should be knowing these type of people. Which one is good? It will depend with the character of the individual, the manager himself. The character of the manager himself to do that will determine the level of risk you can take into control. So an investment has risk, and because they have risk, it is important for you to manage these risks. We don't run away. We manage risk. That's the responsibility of the manager of today. Set a strategy for investments. You must set strategies that align with the organization goals. You set strategies that align with the business operation. You set a strategy. You align your staff. You align your people. They stay focused. They will realize that this is the way we have to go, and that's the strategy. But if they don't know strategy and how to walk around, you will collapse. You will collapse. So a good manager must evaluate how the investment fit into existing business model and whether it supports the company's long-term growth strategy or not. These are things. A good manager will also consider about resource allocation. With resource allocation, a business should consider resources required to pursue investment opportunities. What are those? What are those? You see, as a manager, what are those? So you will need Sapin, you're making noise. You're making noise in my class, then you are disturbing us, Sabine. You are disturbing us. I will remove you if you repeat. Now, capital allocation strategy. You must develop strategies for capital allocations. One of them, of course, we have already said, the return on investments. You can look at it. And the way to maximize the profit, we have said, discovered that one. And also, Sapini, you are making noise. Okay, Sapina, you are making noise. I will remove you in the class if you continue talking. Sapina. Somebody, Sapina. Maybe I will remove you, then you rejoin. Let me remove you so that you can rejoin later. Yes, you will rejoin. You can rejoin. You can rejoin after some time. Sapina. Yes. So that we are in a class right now. I want everybody to concentrate in our class. Don't interfere our class. Okay? So that is very important. So you will look at the different areas for returns, include risk adjustment returns and strategic priorities, and also diversification. You will need to consider as a manager, and also looking at capital preservations and so on. But as a manager, those are things that you shall be looking. Those are things that you shall be looking. And when you look, you'll be guided by, in your consideration, you shall be guided by the following points for your consideration. You shall be guided by the so-called social appraisal, and the financial appraisal. This is the one that we will talk about. This is the one that we will talk about. Here under financial appraisal, this is where we have capital. Let me write here, capital budgeting. We have capital budgeting. The handwriting is not very smooth like that, but it's capital budgeting. I think everybody can read that one. Okay, folks. All right. Once again, because it's my first time to teach you in a class. Once again, my name is Dr. Moitete. Dr. Moitete, that's my name. And I'll be with you in this area to focus for capital budgeting, investment in capital budgeting, but we will also talk about cost. As a manager, what we need to look, and also we will talk about risks management. We will talk about risk management. But again, in our context of risks, we will also talk a little bit about financial, forecasting financial issues when it comes to new investments. What should be the key issues that we can cover? We will see if time allow us. And the capital budgeting, when we consider about any investments, we consider from the aspects of the social, the financial, the economic appraisal issues, the technical issues, the institutional issues, and the gender issue, also the environment. So for us, we are focusing at capital budgeting, and this is the area of financial appraisal. This is the one that we are talking about when it comes to investments. And that is very critical. It's the one that you will present to the bank manager. It's the one that you'll be talking with the bank manager to make a decision. You will say it is viable. You will commit large sum of money. You will advise the board. You will advise management. You will advise the staff. You will advise everybody to get along with the music. Now, what is capital budgeting? If that one has been said, it's like that. What is capital budgeting? What is capital budgeting? Capital budgeting is the process of determining which investments should be accepted, which investments should be rejected, and why do we reject, and why do we accept. This is capital budgeting. Which investments will bring about maximum revenue to the shareholders? That is capital budgeting. Which revenue will bring about wealth to the shareholders without bringing loss? That is capital budgeting. It is telling you about the goals of wealth maximizations. And this is very important. When you check the salaries of the manager, the salary of the manager who is working in UK, how much is the salary? You know, the good thing is when you go to UK, the salaries of each director is displayed in a financial report. So you could see others are getting billions of money because they can demonstrate returns. They can demonstrate welfare. They can demonstrate growth. They can demonstrate changes. Those are the good managers to be hired. Those are the mindset that we think it should be. We think our managers in Africa should be capable of competing with that one of UK and that one of China, with that one of USA. They should be capable of competing one another. Now, the mindset. We need to set our mind properly, and capital budgeting will guide. There should be no any political interference when you are doing capital budgeting. There should be, I repeat, there should be no political interference when it comes to capital budgeting. If there is political influence somewhere, you must get the loss. You will incur more costs, and it will be expensive for the organization. Because of your practice today will cause a loss and the fall of the organization for tomorrow. And therefore, what we say here is avoid political interference when it comes to decision making as far as the capital budgeting is concerned. This is the managerial tool. It is the managerial tool that guide them. I know in Africa it is common to have white elephants. Let me say right here, white elephant investments. It's very common to have this one in Africa because we don't discipline ourselves. Oh, let me come right here. Yes. There are white elephant. White elephant investments. Investment. Now, these white elephants investments, these are those investments that have not been taking into account the capital budgeting. These are those projects. Any type of investments that is driven politically, it's white elephants. White elephants, because it is driven politically. You can have big investment somewhere, you find it's not working. It's not functioning. It's not performing the way it was. There is a problem with how this investment was formed. There is a problem. There is a problem. There is a problem on how the investment was found. And because of that, what you realize, it is a loss-making investments. It is left, it is abandoned. There's so many projects like this one in Tanzania, and some of them were decided politically without considering the white elephants. There are so many projects in Africa like this. It is common to have this, but it is wrong procedure because you are satisfying.
Excuse me, sir.
Yes.
I have a question.
Yes, ask.
Do you will I be right if I say capital budgeting is the same as saying financial appraisal?
Yes. I have said this. Were you present when I was talking? Were
yes,
you
I was.
Yes.
I was.
I gave you explanation. So it is part of this. Okay?
Okay.
Good.
Yes, sir. Thank you.
All right. So, and here, this is the focus. Another question maybe before I continue, because I might be doing, but again, some of you might need some more explanation. Do you have any question maybe? Merere, do you have any question?
No, sir.
Helen, do you have any question? Helen, do you have any question? Eleni. Victory.
Yes, sir.
Okay, now tell us, Victory, tell us example of white elephants investments in Tanzania. Can you point out one? I believe I'm talking to master's students, masterclass students. You are managers, and some of you are directors already. So I'm talking to those people who are serious. This is what I believe. Isaiah, can you tell us, Isaiah Mrema, can you tell us the White Elephant Project that you know in Tanzania? Okay, you'll go and find out. Even Isaiah cannot tell me. So I'm talking to master's students.
Can I try, sir?
Oh, please, lovely.
Can I try, sir?
Please introduce your name, please.
Susan.
Susan, very good. Yes, try.
Okay. What about General Tire in Arusha?
The general type. Okay, you are asking the class. You are asking the class. You are not asking me. Is General Tire a white elephant project?
Yes.
Who said yes? Yes. Tell us. Samuel. Is that Samuel? Is that the voter?
Yes.
Yes. Is General Tire a white elephant project? The good thing is, yes, Zoom user. So should I call you Zoom user because you are using Zoom? So you call yourself Zoom. So should I call you Zoom user? Now, Zoom user, speak out.
My name is Ali Mandela. Is it the Machinga Business Complex in Dar es Salaam as an example?
I don't hear you. I don't hear you properly. I don't hear you.
I
Properly. I don't hear
I'm
you.
sorry.
Yes, you are vibrating. You will tell us later. You will tell us later. Okay. But anyway, thanks. You have been very active.
Doctor,
Appreciate so
Can I
much.
try to?
Isaiah,
Doctor, can
you
I
come.
try?
Yes, let me start with Isaiah. Isaiah, tell me.
Yes, Doctor, I can comment on a general tile project
Yes.
that I think is not part of the white elephant job because the demand of tiles in Tanzania is high. So it's not part of the white white elephant project.
Good.
I submit.
Good observation. I think it's good observation. Very good observation. The demand is there. There are these investments. Okay. Maybe before I comment, Faith, you had something, is it? You had a point you wanted to raise. Faith.
I think all monopoly project of our nation is white elephant like SGR, TANESCO, and the narco branches za taifa. Sorry.
Okay, I don't want to put comment on it because we have to discuss. We have to get a way out of it. Chelsea.
Doctor, can I try one?
But you should be changing. Let me go to Chelsea.
Doctor, I also want to try.
Hello,
Yes.
Doctor?
Yes. Try.
Yeah. Since you're talking about demand, what about Machinga Complex as a white elephant investment? Since there's a variety of products that are in need, like you have those ones who are selling shoes, other ones with coats. So I see that place can be an example for white elephant investment since a lot of demand is raised there. How about that?
White elephant project.
Yeah, the Machinga Complex in Dar es Salaam.
No, okay.
Can I try, Doctor?
Yes, try. Yes.
I have an active example. How about the Dege Eco Village project in Kigamboni, the one initiated by NSSF?
Dege.
Yes.
Okay. What is all about Dege?
Okay. It was initially built for billions of shillings by NSSF, and then it was later flagged as a failed project by the government. So the government tried to resell the project, but since then up to date, no buyer has bought the project, and all the billions have gone into wasted.
Yeah. That's the good example. These are the good example, but it's a good example unless you create a market on it. If you create a market, then it can come back. You need to come up with. Yes.
Doctor,
Can I also give a try?
What about Kiwira Coal Mine?
Very good. Somebody says Kiwira Coal Mine. Can you tell us?
Yes. Yes. Before it was working, But after the mining was there, nothing is going on. It's just like the company is not working anymore.
Okay.
Yes, doctor, can also give a try?
Yes, try.
Yes, we've got a Chato Airport project. It also seems to be a dark kind of project because we rarely see flights going that side there, and you had a very big project there. So I think also Chato Airport.
Very good, very good.
Can fall into that category.
That's very good. That was decided politically 100%. There was no analysis for a net present value and also looking at customers' demand and so on. Very, very right. That's the good example. That's the good example. And the Dege one, the Dege in Kigamboni is also a good example. So others have been speaking about General Tire, Kiwira Gold Mine. These investments are viable until today, even if you get any serious manager can revive these industries. It's only that it was privatized to those individuals in brackets. I don't want to define much by now, but you should know that General Tire is highly needed, and the market for tire is high in Tanzania and East Africa. And we used to produce the best tire in East Africa and SADC. And Kiwira, the coal mine, is needed. Now, I put in brackets, that one is not, those are not white elephants. But when you talk the case of Dege, and when you look at NSSF, there are so many investments under NSSF. When you observe, they have no returns on it. And there are so many. So I think the manager in SSF, they should be careful. They should be careful when investing. Do not just pick the money because, you know, you have authority to pick the money. No. Get a scientific support arguments to invest. I agree with you. Even in Arusha, there are some houses right here that belong to NSSF, and now there is no returns on it. The offices are left without people. Nobody is renting, you see, because of, you know, all those kind of capital budgeting issues. So we should be taking this one as a serious. Let no political interference when it comes to decision making for investments. Don't be driven by politics. You should be neutral scientifically. You should be neutral and decide scientifically. Let the data speak by itself. This is what I will say. Because now you are talking of the Chato one. The Chato one, it is very true. I don't know whether nowadays, well, which plane goes there. I think this is something that you need. These are the white elephants projects. And we have other industries. We need a manager to revive, to strategize and revive even the Chato, even the Dege investments. You can revive. You can establish a school over there in Dege. You can establish a university in Dege. Then new ideas comes. You will start growing up. The organization will start growing up like that. And that will be a good strategy for
Doctor, question.
Yes, Mrema.
Concerning the Dege project,
yeah,
comparing to other NHC project are working good. So it's a real estate investment. I see on the Dege project, it's a matter of management. That if you get a good manager who can make the project viable, because the demand of people want to live in Kigamboni is high, but the project is not working because of management issues.
Okay.
So I think it's a bit challenging to say that it's a white elephant project.
Well, that one is left to you. But for me, I'm advising avoid white elephant investments. This will cause a loss to the nation and ourselves. This is my point. And I appreciate for those people who have been contributing different types of investments from their perceptions. It's also very good observations. For lesson purpose, it's very good. And therefore, financial manager must be able to decide whether an investment or the project is worthwhile undertaking. You must have enough intelligence to support that. Now, what are the factors? What are the factors? As a manager, you should be looking at. What are the factors? As a manager, that will be using when it comes to investment decision. The size of investment itself, how big the investment is. What is your expectations? Of course, as a manager, you should be dreaming big for the organization. We don't narrow ourselves in terms of a narrow mind. No, think big, be innovative, come up with an idea that is going to impact 10 years, 15 years, 20 years, or 30 years. As a manager, come up with big investments. As a manager, dream big. You have that authority. You have been given power to state and come up with investments. Now, the size of the investments will determine capital budgeting. If it is a small one, you can use the payback period. If it is a bigger one, you use net present value and internal rate of returns. So the phasing of the expenditure. What are the phasing? You may require certain amount of money, but in installments. The period between the initial investments and the asset actually generating revenue. So when are you going to put the initial investments? And also, when are you going to generate revenue? And for managers, the year zero, the initial investments, this is the year zero. This one right here. This is year zero. So this is the time when we think the expenditure, the costs that are supposed to start with, we call it at year zero. This is the time for grace period. You can negotiate a grace period with the financial institutions. This is the grace period. This is before revenue has started falling into your organization. This is before you start getting your profit. Not start getting your profit, but the revenue start falling into your organization. The economic life of the projects, this is the project duration. The investment itself, duration, this is the duration. And the level of certainty regarding the project cash flow. How is your cash flow look like from year, okay? From year zero, if this is year, okay? From year zero, how is your cash flow go? Yeah, yes, this is my year. How? Year zero, year one, year two, year three, year four, year five, year six. So as a manager, you will think, etc., etc., etc. Your mindset for investments is the livelihood of the organization as a manager. If you cannot think, allow other people to bring idea to you. As a manager, you will think about these investments in terms of number of years that this investment requires with a given duration. How much is the working capital required? What are the risks involved in this project or investments? What are the risks involved? So we can use different type of methods. We can use the internal rate of return. We can use the payback period. We can use the internal rate of return. We can use the payback period. We can use the profitability index. We can use that. We can use that. But in the real world, when you go to the real world, 75% companies use NPV as a criteria for capital budgeting. 20%. 20%, yes. Use internal rate of return as investment decision. But the payback period, at least this one, 5%. 5%. They use that one. 5% use payback period. But for people, when you go to these Mama Nitilie, people with a small business, toyo business, they know this is small. The pet. Most of them use payback period. Man, if you go to China, you will get one container. You bring to Tanzania, you get this amount of money. Let's go to China. That's how they do. Man, if you get one toyo and bring it right here, you per day, it will give you 10,000. They get a toyo for today because there is quick money coming in. So these are 5% in terms of corporate. But now, when we talk of bigger corporates, you're talking of billions of money. No, you cannot use the payback period. You cannot advise scientifically. You will take some time to avoid. But because why? It has some longer period. It can take 5 years, 3 years, 5 years, 7 years, 10 years. So inside there is a time value of money to which it's very important for you to consider the time value of money. But when you use the payback period, it ignores the time value of money. And this is the weakness that the payback period of time it has. You see? So these are things. So many companies apply NPV. This is very common to any company. We are not doing it for joke, but when you go to the bank, that is the reality. That's the reality. You can use the profitability index, accounting rate of returns, this cost-benefit ratio, you see, and so on. But it should be those ones that demonstrate the soundness of the investment. Any investment criteria that brings soundness of the investments, that is the one that we need to use. And that is the area that we consider for any manager who is studying MBA must consider that. Don't go for white elephant investments. Don't go for white elephants investments. Don't allow, unless otherwise you have your own preference, but let us invest in the area where there is maximum profit to the shareholders. maximum profit. And you must be strategic to those investments. You must be strategic. Now, area that we may find ourselves applying, you can go for this type of investment. You can go for farm investment. You can apply the capital budgeting. You can go for power plant projects. You can set up a solar farm anywhere you want. You can come with the highway project constructions. You can go for flight investments. You can go for communication business. You can go for Vodacom, Airtel, and so on. So you will go to any type of investment that you consider is important when it comes to investments. Are we together, folks? Are we together, folks?
Yes, sir.
Yes, sir, we are together.
Yes.
Yes, sir, we're together.
Excuse me. Do you have any comments? Do you have any comments?
No comment.
Yeah, thank you. Now, as a manager, the investment criteria that you will use, you can use this one that consider the money concept, and you can use this one that consider that ignore the time value of money. So the good thing about this, they take into account the time value of money. That's the net present value they generate of return. Now, you must take risk. It's not necessarily I should say you must take risk, but because we have two types of managers: the risk averse, they fear getting losses, and there are others who take risk, and these are the organizations that perform. The time value of money. Any investments is characterized with cost and benefits. And therefore, because of cost and benefits, there must be a time value of money. There are time value of money for the costs. There's time value of money for the benefits. And therefore, you will decide based on the time value of money. The time value of money, it reflects ability of money to earn interest over time. You will go and talk to the manager. You talk to the bank manager. Hey, we are requesting right here, we are requiring 5 billions. And we find these 5 billions, we can construct this and that, or we can do this type of investments, given the scenario of the business itself. And here it is. They'll just say, we give you interest rates of 14% or 15% or 20%. You should consider the time value of money, given the interest rate, because the interest rate will be changing with a given period of time. The interest rate will not be the same. Interest rates is eroded. The interest rate is eroded. Oh, the value of money. The value of money is eroded with inflation. Godfrey, you are talking. Godfrey, you are talking. If you continue talking, I will remove you. Godfrey, you are talking. Okay? Okay. Because you have failed to You have failed to respect. I'm removing you. Okay. So that next time we should not be talking unless I give you chance to talk in the class. We are in the class right now. So you should understand the value of shilling received today worth more than shillings to be received in the future, as it can be invested into any interest rate over time. A preference for money today rather than money in the future is likely to be rationalized, and not only in terms of the interest foregone, but also in terms of the uncertainties associated with the receipts of the cash flows and the possibility of falling purchasing power. These are things that will be happening. The purchasing power will fall due to inflation. Should understand, and investments will have to consider the interest foregone, the uncertainty of the cash flow, receipts of the cash flow will be not the same. And also, inflation is eroding the business. Now, discounting. What is discounting? So we have to discount. Discounting is the process of determining the present value of payments or stream of payments that is to be received in the future. Given the time value of money, $1 is worth more today than it would be for tomorrow. It's just like today. Today, you look at the value of dollar is not very much stable. And given the trade warfare, because in the world today, there is a trade warfare going on between the United States and China. We have the trade warfare going on between United States and United Kingdom. We have trade warfare that's going on between the United States and other African countries. These are trade warfare. And therefore, what will be the future of US dollar if they do not correct themselves for Tanzania, for Kenya, for Uganda, for Chinese, and for UK and other countries against USA? It means the power of the dollar, when you predict, is likely to fall if they cannot correct themselves. And therefore, $1, if you have the US dollar today, worth more rather than having $1 tomorrow, because of the likelihood of events that are happening. So if you're a manager engaging into international investments and so on, of going and borrowing from international markets, you should consider very carefully your decision. Should consider very carefully your decision. You should know. The world is no longer the same. The world is no longer the same. You should know the shilling. The value of shilling is more valuable today than tomorrow. Tomorrow is characterized with so many assumptions. And that is the thinking of the manager today. But you have to take risk. You will have to take risk to encounter that one by yourself. So discounting permits comparison of different project investment with different profiles of cost and benefits. Now, you should know, when we are computing, we should know the benefits. We should know the cost in monetary terms. When we use compound interest, we say this is your ending amount at a point of time in which future value, of course, it should be worth more than the present value. This is the future value. You are looking for future value. Okay? That is compounding. When you do compounding, we say you are looking at the future value. I think you know. So the future value computation is given by this one. Okay? Vn is the future value, and this one is the future value, and R is the interest rate, and 1 plus R power n is the interest rate or future value factor. This is the factor. This one is the factor. This one right here, power n. This is the factor, the future value factor. What will be the future value? This is your ending amount at a point in time.
Excuse me, sir.
In future. Yes?
Excuse me. I'm so sorry. Do you mind if you go back to the last slide? We haven't captured the formula yet.
This, I was saying, this is your ending amount at a point in time in the future. And this is the future value. Okay? You are looking at that level. What will be the future value of this amount of money? So the future should be worth more than the present value. Okay? Provided it is earning interest rate and growing over time. And therefore, it must have good future value. And in order for us to determine that type of investments, we use this formula. This is the basic. That is the basic. Now, managers, you shall be responsible to do investments. Some of the amount of money you can keep, you can buy bonds with it, you can buy treasury bills with it, you can put into fixed deposits and any other type of investments that we consider is important. You will have options to decide by yourself. This is your ending amount at a point in time in the future. It should be worth more than the present value, provided it's earning interest rate and growing over time. So, and these interest rates, the interest rates. What is interest rate, folks? What is interest? What is interest rate? Can anybody try? What is interest rate? Can anybody
Doctor,
try?
I think, Doctor, the
Yes,
interest
please.
rate is the potential increase that is we expect is the rate under which the value is to be increased. So it's the interest rate, as in the rate we expect an increase from. It can be the rate that we're going to pay extra, the extra amount that is charged for a service or for a loan or for any value of money that we expense. Yes, the expense.
Okay, very good. But
Excuse me, Doctor, could I try too?
yes, very good. Jamira, welcome.
Yes, interest rate is the cost of borrowing money that is expressed in percentage.
Very good. Excellent. This is the cost of borrowing money, the cost of capital. That's very good. This is the cost. And that's why inside there must be thinking of the inflation. The inflation. Inflation. There must be inflation. You know, when you go to the bank people, they're business people. The bank people want to maximize the profit. Of course, when you look at banks, they normally maximize, especially in Africa, where interest rate is very high. And that's why our investments cannot peak, because banks, they're getting more money from business. With the given interest rates today is more than 15%. Market lending rates is more than 15%. This is only interest rates. And also, when you look at it, how much do you earn when you deposit money into the bank? Can someone tell me? How much do you earn? How much do you earn today in Tanzania if you are to deposit money into the banks, into the fixed deposits? How much do you earn percentage per year? Now, Haduda?
Sorry, sir, can I try?
Yes, Pendo, try.
It starts from 3% up to 7% for some banks, but others go up to 10%.
Very good. At least 7%. Let's say you get 7% on CDs. You get 7% on CD. When you deposit your money into financial institution, they will give you 7% per year. But when you borrow money from banks, they will charge you 15%. What can you say about this number? What does it mean from your mindset as a manager? As a manager, what does it mean? As a manager, what do you say about it? This is not correct to African, to Tanzanian economy. It's not correct. To Kenyan economy, it's not correct. Okay? It's not correct. When you deposit money into the bank, they will charge you, they will give you 7% per annum. But when you get a loan, they will give you at 15. So you will realize, and they give you at 15, but there are hidden charges. There are gimmick charges of which we need to change those ones. Insurance fee, what other expenses of which are not good to business flourishing. They are not good. It is something, this is the area that if we want nations to develop, we should look at it very careful, very careful. We can change our nation to grow so fast, because now you find there is a trend for abnormal profit for financial institutions, especially in East Africa. This trend is alarming. It means they are sucking more money from business and individuals. So, manager, you should be interested with assessing the level of interest rates and the future outcome of your action, what will be? Also, consider the level of inflation. If inflation is 4%, what does it mean? What does it mean? This is the managerial mindset. Is the managerial mindset is the game changer for your company. Is the game changer for your welfare. Is the game changer for your decision making. With the given period of time, the given period of time. This is the given period of time. That one. N is the time. That is the time. So, managers must know in the future, I will earn this. So you can set priorities between now and the future. For example, write down that example the way it is. Can you write it down? I give you 2 minutes to write it down the way it is. Have you finished? Have you finished? Have you finished?
Not yet.
Not yet, Doctor.
Let me lab this one. I don't want you to copy. I don't want you to copy. Some of you will be copying, but yeah, some of you will be copying. Have you finished?
Yes, already.
Because I've been talking too much, I got to drink some water so that I get energy to continue talking. Good. Now, what is your answer? What is your answer? Apply that formula to compute. Apply that formula.
Okay, 583.5.
How much?
583.5.
Okay. Okay. I get this one. That's the answer, is it? That's the answer. Did you get that? Pendo? Did you get that?
Yes, I get it.
You get the same? Okay. Otherwise, I just say,
I get it.
eh? Pendo, did you get the same?
Yes, I got the same.
Good. Merere, did you get the same?
Let me redo. But
Redo it. Otherwise, recall your mathematics. Kevin, did you get the same?
Yes, sir. I've get the same.
Okay. Mercy, did you get the same? Mercy, did you get the same? Some are still struggling. Okay, you'll get the same. But knowing that you have 1,000, this is your what? What is your 1,000? What is your 8%? And this is 7 years. Okay? So when you apply the formula, the initial capital is this one, the VO. So the VO was 1,000. If the VO, okay, we say VO is equal to 1,000. 1,000. Okay? And also, the R is equal to what? 0.08. Yes. And also, what is the time? The time, the N or the T is how much? Is 7.
7 years.
Yes. Now, if it is 7, you plug in the formula right here, your formula. Which formula are you using? So we are looking V at year 7. Is it? This is what we are looking. Is equal to what? You plug in the formula just like the way it is. Then it gives you the answer. Managers, are we together? You must get this one. Otherwise, recall your mathematics. Yes, so we apply.
Yes, sir.
Good. Now, so your decision on whether your money should stay 7 years and get that one, yourself, you will know if you have the idle resources. Your decision will justify. But I tell you, if you get a big sum of money, you invest. Risk-averse managers, most of them invest into risk-free assets. We call them RF, risk-free asset. These are risk-averse managers. Most of them, they will invest into it, but without knowing the implications of the interest rates and also the future value, and in terms of the present, they cannot calculate and examine. You could better consider yourself going into China and getting a container of clothing and bringing it to Tanzania and get good sum of money. You leave. These are the points that as a manager you should be thinking so fast. You make quick decisions. You're looking at the world in different pictures, and you move at the speed of the organization, of the world. Are we together? Are we together? You will have your practice question. You will practice again by using the same. So you will do it. Present value. We are looking at present value. This is the current starting amount. It is the money you have in hands at the present time, your initial investment for your future. Various costs and benefits for this might happen in time, can be expressed in terms of value today, their present value. Their present value. I don't know whether you understand, because sometimes many students tend to confuse when you give them a question. When you ask them after sometimes they have already forgotten what does it mean, you see. But here, your initial investment for the future, what you need to have for present time, the present value. And the other one, we are looking at the future value. So this, in order for you to derive the present value, you simply require the reversal of compounding process. And this is generally referred to as discounting by taking the PO. You take the whole sum divided by 1 plus R power n, which is sometimes is equal to Vn 1 over 1 plus R power n, where R is your interest rate, the one that we have already said, and the Vn is the value in years, okay? And the VO, the sum of available, the sum of money available today. What to require today? What to require today? What to require today? What the sum of money required for today What do you require for today? You see, this is what you need to look at. It's just a reverse of compounding, but you are looking at investment for today. How much you require for today, the present, the present, the present. Now, consider the following. Write down those questions. Write it down. I give you some 3 minutes to write down those questions. Write it down, those questions. Have you finished? Have you finished?
Not yet, sir.
Not yet.
Okay, finish.
Not yet, sir.
So I believe you have already taken it down. You will do yourself as part of your homework for tonight, and we will continue for the next time. So that is the way we will have to. We have already said about this. We don't need to repeat again. But now let me look for a bit about the net present value. When it comes to assessing the viable investments, business is characterized with uncertainty. Business is also characterized with purchasing power by itself due to inflation, and also there is cost of capital. This is what the business is facing, and any type of investments, that you are considering is characterized with that, unless if it is donor funds or for investments or maybe grants supported by the government. That will take a little bit in terms of the decision. But in here, when we talk of the net present value approach to investments, it requires all our cash flow, this one, our cash flow, sorry. It requires all our cash flow to be discounted, to the present, to allow the time value of money, Then the discounted cash flow can then be summed up to determine whether the investments is expected to produce a surplus or a deficit. This is what we are looking at. Can it bring about surplus or deficit, profit or loss? Can it maximize the welfare of the shareholders, or it will not be able to maximize the shareholders' welfare? If it's not, then you don't need to go. We say a positive net present value, it indicates the capital committed to investments, and it can be recovered. This is when we talk of the investments. And therefore, the interest cost can also be covered. You should know one thing. It is a culture, most of us. We go to the banks, we borrow money to finance our car. It's not good culture. That is not. Christina Kimaro, mute yourself. If you keep on talking, I will remove you. Okay, so we are in a class. What is happening here? I said the individuals, most of us, we borrow money to finance cars without knowing the implication. And some of you borrow big sum of money without knowing the implication of borrowing. Never borrow money to finance your car that will take you from office place to home. That is wrong approach. When you do that, man, you are wrong, man. That's not right, man. You're wrong. 100%. We borrow money from financial institutions only there is future returns. And therefore, you must invest the money. You must have to invest the money. You must demonstrate profitability. You must demonstrate your cash flow. Because the banks will demonstrate how you pay. That's the installments. What will be the source of your revenue to a country where now the interest rate is more than 15%? No, man. No, man, it's too high. It's too high. Business cannot survive. Now you go and borrow 60, maybe 100 million. Some of you guys borrow 100 million. You borrow 100 million to finance your car. You are wrong. That is not sustainable way. As a manager, you are wrong. You are wrong, manager. You are wrong, manager. A manager who decided to borrow will borrow and invest in investable areas. Some of the managers, they borrow to finance expenditure, to pay salaries. No, we don't borrow that way. We don't borrow that way. We only borrow to finance the investments, operation, and get surplus and avoid any kind of issues that we consider negative. So, when it comes to that, we say, you will accept the investments. You will accept the investments when net present value is greater than or equal to 0. You accept. When any PV is greater, is greater than or equal to 0, you can do investment with that. If it is 0 equal to 0, you are at break even. You can do an investment. So long any point less than 0, don't go for it. Are we together? Any PV is less than 0, reject this type of investment. You will accept for this type of investment. Are we together, folks? You understand what I'm talking?
Yes, sir. Yes, sir.
Okay.
Yes, sir.
Yes, that's okay. Okay, very good, very good, very good. Now, a serious matter, because I said in a corporate world, in a corporate context, for today, 70% use NPV as decision criteria. When you go to the bank, you have a good proposal by yourself. You have good investments by yourself. You talk to the bank managers and that, I think if you give me money on this, we can make good business. And you can demonstrate the capability. The bank manager will offer you financing you require to do any business. It's only that many people don't have confidence. They don't know what are they writing for. So you need to get confidence. You need to know you can even do your business, import and export business, import and your export business. You can conduct your investment decision